Ukraine war has made normalization more difficult. Other key factors in explaining the cross-country differences include the lack of a fiscal union in the EU and EMU and the lingering effects of Brexit in the UK. In this panel, these themes and others are going to be developed in 4 fascinating presentations. So we will start off with.
Thanks a lot, Michael. Thanks a lot, John, for the Hoover Institution for inviting me, and Luis. Luis and myself are going to present part of the work which is based on a book together with John Cochrane, on which we are working. The foundation architecture of the euro, which was set up in the Maastricht Treaty 3 decades ago, more than 3 decades ago, for monetary union but no fiscal union. Europe, or the EU, has some elements of a political union where there are centralized decision making, but Europe is far away from a federal state, from a political union as the United States. So the fundamental philosophy of the treaty was that there's no fiscal union, so the central bank focuses on price stability. It has a prohibition of monetary financing of government budgets. There are deficit and debt limits for every country, and there's a no bailout principle for public debt. This together made very clear, but it was not explicitly written in the treaty, that in case you have over-indebtedness, in case you have much too high debt of a country, which cannot be solved by tax increases easily, or spending cuts, you need a sovereign default if you want to stick to the first objective, price stability. But that, I come later to this. The ECB, in the first decade of its existence, had a small balance sheet consistent with this framework, this clear separation between monetary and fiscal policy, small balance sheet, no excess reserves, and it did not buy any government bonds. And it was very clear in speeches and in articles, whatever, we are not here as central bank to support individual member states which are in trouble. Like all great institutional innovations, the treaty had some missing parts. Neither the treaty nor secondary legislation at the EU level explicitly established how countries could default, so how the no bailout clause was made credible, how banks in the financial sector could be insulated from the cost of a government default. It did not establish a crisis resolution body at the European level to step in like the IMF would do in balance of payment crisis or in fiscal crisis. And it did not establish anything close to a banking union, nothing. These missing parts in interaction with a number of shocks and crises during the last almost 2 decades risked to distort incentives and created vacuums. During the crisis, the ECB central bank continued to focus on price stability, but given the missing parts, its actions, its interventions moved it more and more into decisions which had significant fiscal implications, and as a side effect, which also provided balance of payment financing for certain member states which were perceived weaker by the financial markets and where private capital was flowing out. The ECB effectively was putting in public loans, money. I'm only on the second part of this slide to save time. The ECB in the crisis started to buy bonds, and it's important to understand that there are 2 different types of bond purchases or announcements by the ECB. The first one is, and it started 2010, to buy bonds of individual member states in trouble. Not of the whole euro area members, but only of individual member states in trouble. The second type of bond purchases are more similar to what the US did, a broad purchase of bonds of all member states, but different to the US, the ECB The bulk of the government bonds the ECB buys are national bonds, which may have and have different default risks. That's, of course, not to a large scale the case here. This is a bit complex slide, and I'm not going in details. The red arrows show 3 phases. The red arrows which go down show that these missing parts of the treaty in connection with crisis created, say, a blurring of the distinction. The red lines going down show developments, decisions, which in interaction between the missing parts of the treaty and the crisis or the big shocks, we are moving more into a blurring of the distinction between fiscal and monetary policy. We are moving away from conditions for sound public finances at the individual member states. In the middle part, you see there were strong and good efforts by the member states during and after the sovereign debt crisis between 2011 and 2014 to improve institutions, to set up an IMF-type ESM, to strengthen the fiscal compact, so fiscal discipline. So that moves up. That moves back to the founding idea of the monetary union. But unfortunately, in the third phase, we are going again in the wrong direction. We didn't use, member states did not use the good years between 2014 and beginning of the pandemic. Big member states did not reduce their debt and so on. And we had then an example, the ECB had to take the so-called TPI decision, which means transmission protection instrument, when it had to increase interest rates, like Michael mentioned, to counteract inflation. It was needed to announce a protection of bond prices because there was a fear that spreads would go up too much with higher interest rates, the spreads between government bonds of member states. So the ECB announced a support, and this TPI support was different from what Mario Draghi 10 years before announced with whatever it takes, because the TPI support did not require ex ante that member states agreed on an adjustment program, did not require that member states put money on the table before the central bank would step in with bond purchase. So that moves, it shows that the missing elements of the treaty were still active and moved us in the direction of blurring the distinction between monetary and fiscal policy. I think I almost spent the time here. You see that the blue line on the Japan is way above, then the blue line is the ECB. It had roughly 2022 more than 60% of 1-year GDP in assets. 5 trillion of that in 22 were mainly bonds, mainly government bonds of national member states, and 2 trillion, a bit more, were loans at favorable rates to banks. And now I'm at the last slide. One of the missing elements is that this one, the doom loop risks between banks and sovereigns, have not been addressed. We still have a risk here. You see that some member states, the banks of some member states, have a high exposure. More than 100% of their capital they have exposure of more than 100% of their capital in their own government, so with holding bonds of their own government, and this creates the famous doom loop. Regulators have not taken action, so it's not the ECB, but regulators, governments, to address these problems. And then I hand over to Luis. Thank you.
Yeah, thank you. Thanks very much. So the theme of the book that, by the way, John Cochrane just put in his website, so if you're interested, you can read it, is that post-crisis, all of these actions that were necessary during the crisis, all these emergency actions that the European Central Bank took, have blurred these boundaries between monetary and fiscal policy, have inevitably pushed the ECB into a role that basically finance states and finance banks. Klaus has talked about financing states. Let me just briefly tell you about one of the other consequences of the crisis is that banks are still getting subsidized financing, this full allotment fixed rate financing they're getting in exchange for weak collateral, basically the same collateral conditions that you would use in emergencies are still in place. And that means that basically the whole price mechanism is suppressed, and we don't really know if a weak bank is weak or not. It's no wonder, and this is from Isabel Schnabel, one of the board members in a recent speech, no wonder that the states haven't really felt the need to put their fiscal house in order. This is particularly the big member states have really never fulfilled the rules that were set when those when the monetary union was put in place. Just in the last couple of weeks, we have seen Italy announced a deviation of 2 full percent points in their deficit estimates to over 7%, maybe up to 7.5%. France, similarly, over 5.6%, also a deviation from 4.4 for next year, also over 5% deviation in spite of big budget cuts. So basically what you see is there really is, with this cheap, easy financing from the ECB, the member states are not really feeling the need to put the house in order. And I wanted to tell you a third instance. So these are the big member states who are kind of able to not fulfill these rules. The third instance is the pension situation. This is from last week, and the key bar is that blue bar, which evaluates the pension reform in Spain. There was a pension reform last year. It was a counter-reform that undid all the reforms from the 2010s, and that basically has increased the long-term structural budget deficit of the pension system by 6% points over the medium run. 6% points of GDP. So basically, what we say is, look, I mean, yeah, crisis tools, all right, but if you don't do anything to remove them, you basically have a central bank, it's the only game in town. We don't say the ECB was wrong to do what it did, but if we don't do anything about it, we just have a completely weak set of institutions. So we make several proposals. I'm going to go very quickly over 3. So basically, we say, yes, you can do monetary union without fiscal union. I mean, some of us I believe that fiscal union would be ideal, political union would be ideal, but it's probably not quite feasible right now. So what we propose are, and I'll say it very quickly, first, a European financial institution, an actual kind of powerful kind of body that can unburden the ECB from the current role of rescuing left and right any member state who gets in trouble, and that can actually do programs, conditionality, recapitalize the banks, etc. So that's a first key reform. A second key reform is we need to complete the banking union. Markus and I were working already on this problem more than 10 years ago. He, by the way, also has a book on this set of problems. We basically put in place in 2013 a path towards banking union that involved deposit insurance. There is no European deposit insurance. That means member states are in charge of any weaknesses. Yes, any weaknesses on the banks are actually the responsibility of the individual member states. And at the same time, the banks are buying all these bonds from their own member states. So concentration charges, or at least risk weights that are only risk charges that are only zero when the bank is properly diversified. And finally, we think that the balance sheet needs to change radically, both in purchasing the debt of the member states. So we think that the ECB should only purchase European debt over the medium run, and not, so the Fed shouldn't be buying Kansas debt, but US debt. That's the idea. The ECB should be buying European debt, not member state debt. And they should stop subsidizing banks relative to market conditions. So the non-marketable securities should only be purchased in the context of emergency liquidity assistance. That's basically the idea, moving back towards a system where those boundaries are clear by having a fiscal institution doing the fiscal tasks, by completing banking union, and by getting a balance sheet that actually essentially returns to small and not financing banks and states as it's doing now. Thank you very much.
So thanks a lot for inviting me and for giving me this opportunity to talk. I will talk about something different. I will talk about the digital euro. just to contrast it to the fiscal side. And it's more a long-term thing. And if you take one message away from the digital euro, I would say it's more geoeconomics than real economics. Okay. And you might ask yourself, what is really a digital currency? Isn't your checking account already on your app and it's also digital? And I think what I call digital money is essentially a money which is connected to a ledger, and the ledger itself is connected to many, many other ledgers. So you can execute things automatically. So the ledger essentially has a money component, has a payment system component, and if you can connect it with many, many other ledgers, it becomes programmable. And so you can connect it to supply chain ledgers, you can connect it to big tech ledgers, lenders, and platforms like Amazon, Alibaba, and so forth. And you can also connect it to a credit ledger. So if something is very interconnected, then it becomes much more useful, much more a digital money feature. You can execute things automatically, settlement happens automatically, you can have smart contracts and so forth. And then the big question is, who controls this ledger? Who has the power to control this ledger where everything is recorded? And of course, the different schools, you can have private money, you can have public money, you can have a private-public partnership. The two polar cases essentially is the libertarian view that you would like to have a lot of competing private monies, like a la Hayek, or the other extreme is you have only public money, like the sovereign money. There was in Switzerland a famous referendum some years back. So these are two polar cases. And you might say, okay, let's have some private money case, and later I will talk about the tiered system, the PPP we have in the money case. So if you have a private money case, so traditionally what happens, you have the private entities making some initial coin offerings. Then, you would like to make this coin a little bit more systemic, and then you get a public guarantee on it. And the initial offerer can actually extract a lot of rents from this. And actually, a private money also has, of course, a lot of, not the incentives to invest in resilience in the system. Okay, that's essentially what you have for private money. In the payment system, there's a lot of rent extraction possible too, because you have this exclusion power. You can actually say, I exclude you from the ledger. You're not part of this ledger anymore, from this platform or this ledger. That helps. You can enforce credit much more easily. Say, okay, if you don't pay back your loan, you will be excluded from the payment system. And that makes credit enforcement much more powerful. But it also leads to a natural monopoly, so it leads to rent extraction. And of course, the private sector also has some incentive to keep inefficiencies going. And we see this a lot in cross-border banking and cross-border payments as well within Europe. Of course, that's a problem with totally private systems. So how do you deal with that is to have, a private-public partnership. So you have central banks, we have banks, and we have stable coins in a sense from the money side, or you have also big tech platforms on the ledger side. And you would like to anchor different forms of money on one single form of money. And how do you do that? And there are two ways to do that. The traditional way is to have convertibility. So they say when you have a checking account, a deposit, you can convert it into cash, and this convertibility anchors it on the central bank cash. And the question is, if cash goes away, do we need CBDC in order to enforce this convertibility approach? So the convertibility approach is like, you offer a public alternative, and that alternative you can convert into it, and that anchors the whole thing on a single currency. And that's very important. I will come back to this uniformity of money. In Europe, so in the old days of free banking era, you had a lot of currencies floating around, or banknotes floating around. And in Europe, we also have this, in the euro crisis, redenomination risks. That means, the Spanish euro is different from the German euro. The Greek euro is different from it. So you would like to have the uniformity of money to have this uniformity going on. So this convertibility ensures that. An alternative approach is, so if cash is not there anymore and there's no CBDC going on, is to have, through regulation, enforce uniformity. Through bank regulation, FDIC insurance, deposit insurance, and lender of last resort features to make sure that all essentially euros are the same euros. They don't fall apart and they don't become different euros. So that's when you have this arrangement, that's typically how you can arrange it. What's about on the payment system side? How can you make sure that these platforms or these ledgers are not becoming too powerful and extract too much rents? You can say I introduce the CBDC as a competing device. So there will be some CBDC as an alternative, and that actually lowers the possible rent extraction. It also might compete, you'll make sure if the CBDC has very privacy protection, that the private sector also has to provide some privacy protection. Now, just to give you an idea how we can set up the CBDC and how interconnected it is, so one option is to, and that's essentially what's currently planned in the digital euro, to have a CBDC ledger, or a digital euro ledger, which is a separate ledger. It's not connected to all the other platforms. The interoperability is not the focus of that. And of course, it will be that private money interconnected with all various other ledgers will be more attractive. You can have much more convenience interconnecting things and make it programmable. But if there's too much rent extraction, then you can always switch over to CBDC. So having this competing thing, so that's the competition with CBDC in order to limit the rent extraction. An alternative is, the option 2, is to open up the CBDC ledger or the digital euro ledger and make it very interoperability. So all other different ledgers can be connected to the payment ledger of the CBDC. And then you can also enable all the smart contracts on the CBDC ledger. And in that case, you can also enforce and credit much more easily in all this. And then actually the private sector will actually shift and will then allow and focus on offering side trades or focusing on the black market with its own token. So that depends which direction one wants to go. And so far, it's the option 1. Let me say a few words. The digital euro should be there to contain or maintain monetary sovereignty. What is monetary sovereignty? Most importantly of monetary sovereignty, you think about senior-age generation, but it's most importantly is that you can manage the macroeconomy. So if you lose the unit of account, if everybody's using a different private currency, you cannot actually hike the interest rate or lower the interest. You can do it, but it has no impact on the macroeconomy. So you would like to maintain that. Of course, you would like to have seniorage. And in this context, I would like to say you would like to maintain it and also potentially to organize financial repression. So there is a potential. We have fiscal deficits and fiscal debt levels at record height. At some point, we have to go this fiscal repression route, most likely. And if you have a well-anchored euro on the CBDC, the digital euro helps to anchor it, you have more power to conduct fiscal repression. And I wouldn't rule this out coming up down the road instead of outright default. Of course, there's also, monetary sovereignty is also who can be excluded. If it's an official public money sector, you will not be potentially excluded from a particular currency. That's something like that. And there's also the question, who will be bailed out with the lender of last resort feature. Now, let me come back. So digital euro is also to maintain the uniformity of the currency. We have essentially in our current system, we have many issuers of money. Your deposit account is a money and all that, but we have many issuers, but one money, okay? And one role for the CBDC or the digital euro is to maintain this uniformity of money. So and also in terms of money, but also in terms of payment system. In Europe, there's this European Payment Initiative just to harmonize and force the banks to coordinate and make, instant payment across borders, everything efficient, and that the private banks work on that. And of course, private banks like the inefficiencies because they extract rents from that. And the digital euro is seen as a catalyst to force the private banks to coordinate. Essentially, it's a stick saying, if you don't coordinate and get your act together, that actually payments will be efficient across many, many dimensions, across many, many ledgers, we will introduce the digital euro, and then it will come on the public side. So it's essentially more an out of equilibrium threat to get the private sector into action to coordinate on this and keep the uniformity across the whole euro area. Now, the other question is, of course, how to design the digital euro. And one big issue, and I will just mention this briefly right now, if you think about the policy rate pass-through, it's very asymmetric. The policy rate is heightened, and it's immediately passed to the loan market, so credit is way more expensive, but the savers, they don't get much. Okay? So if you go in the checking account or most of the accounts, especially for people who suffer from inertia, they don't get anything. So there's huge distribution between the alert people and the less sophisticated people. They don't get the high interest rate. They suffer high 6-7% inflation, but they still get the 0.5% of the interest rate. Now, if you have a digital euro which would pay an interest rate, then actually the pass-through might be better. Okay, that I emphasize might be, but at least you can say in the app. So the idea is you have an app on your checking account. There's the bank liability and there's a central bank liability. You can just switch back and forth on the same app. It's a private banking app. If the CBDC, the digital euro, pays you the policy rate, you would switch over very easily. So the pass-through would be very quick. Of course, it will create immediately some financial stability issues because the banks are sitting on many long-dated government bonds or other bonds with a low interest rate locked in. Okay, so if they can't refinance themselves so cheaply by exploiting the deposit franchise, there will be financial difficulties. So if you want to pay interest rate on the digital euro, it can only be phased in. Right now, the plan is to pay no interest on the digital euro. And of course, then there's also the other financial stability issues concerning the runs and so forth. Let me just outline and conclude then how, in different digital currency areas, how it's different. So in Europe, I think it's very much, the digital euro is very much focused on the consumers. The challenges will be to create a smart CBDC where the ledger or the CBDC ledger is connected to other, and is interoperable, is to connect it to the various platforms. The US approach, I would say, is very much not to introduce a CBDC, work with private stable coins and make them programmable. I guess the advantage of private stable coins is that they will be more easily connected across various things. So interoperability can in theory be done, but whether they will do it is a different question. Uniformity of money will be more difficult to inform on that. Traditionally, China's approach was to use its platforms, Alipay and WeChat Pay, to spread in other territories and make this as a payment system across, in particular in Asia. But the current events actually have changed the strategy to some extent because these companies were, were sidelined to some extent. And the other emerging and developing economies, they are essentially afraid of using the unit of account and with it a monetary sovereignty that they can conduct monetary policy because other currencies, other payment systems and different units of accounts will take over. So let me conclude and give you the main takeaways. So the digital euro, there's actually not a very strong business case to be made. In particular, the way it's designed, that it's capped up to 2,000 or 3,000 euros. And if you get an inflow in your checking account, and the first 3,000 euros will be a liability of the central bank. What beyond is a liability of the private bank. I think, as I mentioned, there will be a private-public partnership. That's really very important. To anchor it, you need the convertibility, or alternative, you can perhaps do it with a regulatory approach. We have never done this in history. That is a new approach. Convertibility, we know how it works, convertibility into cash. If cash goes away, convertibility into digital euro might be a traditional way of doing things. I think it's more geoeconomics and geopolitics which are drivers. You would like to keep the uniformity of the e-currency across the euro area, so eliminate the denomination risk, which was a big deal in the euro crisis. And so I forgot to mention that there's also, of course, the merchants, they have to establish new terminals. So the dominance of the US credit card dominance will be undermined as well. So it's a catalyst to undermine the US credit card dominance. It's also the fear of the randomness of another Trump administration is something the Europeans are very concerned about. And you keep the option of financial repression in a more powerful way through inflation. The key is how to design a digital euro. And then one is to make it competitor to private players, competitor in many dimensions, competitor in how much interest you pay relative to the private banks, competitor in terms of privacy you give, competitor with respect to platforms, how much rent they can extract, and also design it in a way that to save financial stability in this case. And that's, I didn't go into this, depends, if there's a run on the currency into the digital euro, then you just channel the funds back. So you have to have a monetary policy in this regard, or financial stability policy in that regard. So let me leave it at that. Thanks.
Well, I want to start my talk with a slide that John showed to us yesterday, which is the dynamics of inflation in the US, in the Eurozone, in other advanced economies. And what you see here is that we have inflation breaching 10%. The timing and the magnitude, varies a little bit across countries, but broadly we see a similar development here. A big increase in inflation, that's obviously bad news. But we also have good news. Inflation is falling, and so we have to be thinking why it's falling so fast. In many ways, it's surprising how fast this inflation is falling. We also know that, again, another slide from John yesterday, we know that policy rates increase everywhere in the US, in the Eurozone, and so some of the credit for this decrease in the inflation we see today obviously goes to the policy reaction. But I say only some of the credit that is going to policymakers is because when you look closer at what was happening with inflation, how fast it fell, we know, for example, from Milton Friedman that monetary policy works with long and variable lags, and inflation here is falling much, much, much faster than would be consistent with that statement. Another way kind of to see why the policy reaction may be not entirely explaining what was happening with inflation is to look at this figure where I plot the dynamics of inflation and policy rates for various countries over time. And you see here that inflation has been consistently above the 45-degree line, which means real rates were negative until very recently. Right, and so it's kind of hard to imagine that you have this massive decrease in inflation just because interest rates are mildly positive. And to appreciate this point, let me show you how sort of a real disinflationary process can look like when it's engineered by a central bank. This is from the Volcker disinflation. The red line is the dynamics of the real rate in that episode. You see that the real rate was increased to 5%, and it stayed at that level for about 5 years. This is how the real disinflation looks like. This is what we have today. Again, we have a disinflation, but it's not necessarily a textbook disinflation. We have only mildly positive real interest rates, and they've been around only for a relatively short period of time. And so again, it's hard to attribute all of the credit, this disinflation that we see today to just monetary policy. Another way to see the same point is to look in the Phillips curve space. Here on the horizontal axis, I have unemployment gap. That's the difference between actual unemployment and some notion of natural rate of unemployment. And on the vertical axis, you have inflation gap, which is the difference between actual inflation and expected inflation. And we first start with the textbook case, which is the Volcker disinflation, and I'm going to split it into two parts. One is the time when inflation is rising, that's going to be the red arrows, and then the time when inflation is falling, this is green arrows. And what you should see during the Volcker disinflation is that inflation was mostly coming from vertical shifts in the Phillips curve, right? So all this, vertical arrows, red arrows that point into that. Then you have the disinflationary period where we are moving along the Phillips curve, right? So we keep creating slack in the economy. We create a big recession, we reduce inflationary pressures. This is why inflation is falling, and once things normalize, that we move back along maybe another Phillips curve, another trajectory there, but we bring inflation back to normal, we reduce inflation back to normal. So this is sort of a textbook case of disinflation. Now, this is how disinflation looks today. The inflationary period is moving along the Phillips curve, right? So we start with a lot of slack and low rate of inflation, then slack disappears, inflation is picking up, that's the red arrows. The disinflationary process, however, is very different. Instead of moving along the Phillips curve, which we typically expect to see when it's a disinflation engineered by a central bank, we see a vertical shift in this space. That's typically consistent with favorable supply side developments. Now you can see this clearly in the US, right? So this is Volcker, this is what we have today. In the Eurozone, it's hard to construct anything which is going to correspond to the Volcker disinflation, but at least you can see what was happening today in Europe, and you see that the dynamic is very similar. The inflationary part is going to come from movements along the Phillips curve. The disinflationary part is coming from vertical shifts in the Phillips curve. And in some sense it's great because we can achieve disinflation very quickly, but it is also telling us that all this disinflation that is happening in the US and Europe is not entirely due to the actions of the central bank. We rely on this positive supply side developments, markup shocks or whatever, that move this things around. So when we look at sources of where this positive supply side developments can happen, in Europe it's very clear it's related to energy, right? So we know there is the Russian invasion of Ukraine, a huge spike in energy prices. Then Europe decouples in terms of energy from Russia. Energy prices fall dramatically, and this can explain why we have this vertical shift down in this space. So when you go back again to this figure and you think about the sources of this inflation, you kind of start thinking that obviously central banks contributed to it significantly, but there are many other forces in play, and some of these forces are not controlled by the central bank, and that means we have to be very careful in our projections and also prepare for sort of worst case scenarios. Now, when you look at this and you think about these worst case scenarios, in the US, it's one set of issues. In Europe, I think it's a different set of issues. And, me being from Ukraine, I think, people don't appreciate that how much danger is coming from the Russian invasion of Ukraine. And Secretary Rice mentioned this earlier, that, we should be thinking very seriously about these geopolitical issues because they can have first-order effects on our economies. For example, you look at the Black Sea, that's a major transportation route for agricultural products, not only for Ukraine, but also for Russia. And we know this route may be easily disrupted. For example, in April 2022, the cost of insurance increased by a factor of 10, which makes basically any kind of shipping in the Black Sea impossible. We know Russian refineries are catching fire for various reasons, and again, this can disrupt all sorts of energy supplies, not only from Russia to Europe, but to other destinations as well. We also know that public finances are very much strained in Europe, especially in some countries. We already had this discussion, and Luis and Klaus mentioned this. But people kind of forget that, this war has a direct drain effect on public finances in Europe. At the peak of the crisis, 200,000 Ukrainians were crossing the border from Ukraine to the European Union. If things go south in Ukraine, it may be 1 million people a day. And then, the cost of supporting refugees may be astronomical. Again, just to give you a sense, Germany is hosting about 1 million Ukrainian refugees. It's costing them 20 billion euros per year to support this. Now, if you increase this by a factor of 10, it's obviously going to be fiscally very, very expensive. We also know that defense budgets are going up everywhere. And if the Cold War is any guide, we probably should expect that defense budgets are going to increase by maybe 50%, maybe double. That's very significant. And through this, we can have more inflationary pressures in the economy. It may be just the standard aggregate demand channel, or it may be a fiscal theory of price level if it's unfunded. There are lots and lots of things that can, again, affect inflation directly here. We also know that many businesses in Europe are still not decoupled from Russia. And, in the US context, it would be kind of a similar situation, but with China. Sometimes it's, regular business, a construction business, but sometimes it's systemically important institutions that still have very significant presence in Russia. For example, the Raiffeisen Bank. If something happens with this bank in Russia, who is going to pay for this? Who is going to pay depositors? Is this going to be the ECB or the Austrian authorities? I don't know. But we should understand that this is a vulnerability, and it is very important to think about these scenarios. Another thing I want to mention is just, we know Russia weaponizes all sorts of things. You have a obvious war in Ukraine, but, it also weaponizes refugees, it meddles in political processes. Sometimes, just, military drones and stuff, fall not in Ukraine, but somewhere else in Europe. We also should remember that Russia occupies the largest nuclear power plant in Zaporizhia. And if something happens there, nobody is going to be, too concerned about, neutrality or anything like this, because radioactivity is not going to respect borders or anything like this. So I guess, there is this general idea that Europe may become a much more dangerous place than people appreciate. And we have this, popular narrative out there about the Korean discount, that doing business in Korea is more expensive just because you have a crazy neighbor to the north and you don't know what's going to happen to you in a day, in a month, in a year. I'm afraid that we may be going towards this scenario as well in Europe, where doing business in Europe may be more expensive, and obviously this is going to have a direct effect on inflation. The cost of borrowing will be higher, so lots of bad things can happen from that. Now, the last slide I want to share with you is something I borrowed from Gita Gopinas and Pierre-Olivier Garincha, where they look at the volume of trade between different geopolitical blocs. So you should focus on the red line. And the black line is sort of a current volume of trade between current geopolitical blocs. And what you should see here is that this dynamic is really, really flat now. So it's not going up, it's not going down. And the last time we saw this was in 1949. That's the beginning of the Cold War, the formation of NATO, when we had very clear alliances drawn. And also in the 1930s, where again, there was a sense that something bad is about to happen and we want to minimize our exposure to potential adversaries and so on. Now, you decide for yourself if it's 1949 or 1939, but in any case, it's not a good development. Something like this is signaling that the world is preparing for a very bad scenario, and Europe is particularly vulnerable to this. So let me conclude with this slide, which is saying that it's great that we have a disinflation. It's wonderful that inflation is falling, but we should also understand that the balance of risk is such that we may have much more stubborn inflation than people anticipate, and we can have a scenario where inflation may rise, fairly significantly, not just in Europe, but maybe in the US as well. So I'll stop here. Thank you.
Okay, so I thank the organizer to inviting me to talk today. So one of the key characteristics of the European Monetary Union is the coexistence between a single monetary authority and many independent fiscal policies. So Klaus and Luis already talked about that. Now, aside from being independent, fiscal policies has also been quite different across countries, leading to very heterogeneous fiscal positions. So you have countries with very high debt-to-output ratios and countries with very sustainable public finances. And since 2010, the high-debt countries have faced quite volatile interest rate spreads and occasional debt crises, with all the negative spillovers that this event have on their economy and on the Union as a whole. So a crude way of thinking about monetary policy, the conduct of monetary policy in this context, is that what the ECB is trying to do, well, it's trying to achieve the mandate of price stability, subject to a constraint that essentially it preserves also the working of the European Union, so that it avoids this occasional debt crisis result in financial meltdowns or in disorderly exit from the Eurozone. So I'm gonna, for a lack of better words, I'm gonna call these additional motives of the European Central Bank sustainability constraints. And so the question I'm gonna sort of talk today about is to what extent the sustainability constraint interact with the price stability mandate of the European Central Bank. And when we think about these questions, there are two different way to approach it. On the one hand, you can have fiscal shocks in, let's say, high debt countries, that may tighten the sustainability constraint and may force the European Central Bank to do something that is at odds with the price stability mandate. So think about all these bond purchasing programs that they've sort of designed over the years in order to sort of calm the spreads. They are not really designed for price stability in mind. In addition to that, sustainability constraint may also affect the conduct of monetary policy in response to more traditional shocks. So think about when the ECB is facing an energy shocks, they may not want to raise rates as much as they should for price stability because raising rates is going to affect the public finances of these high debt countries and potentially tighten the sustainability constraints. So what I'm going to do is I'm going to present some data to essentially think about to what extent these two different types of shocks interact with the price stability mandate. And in particular, I'm going to look at two different event studies. One is the formation of the Italian government in 2018, which I'm going to think about as a direct fiscal shock to an high debt country. And I'm going to talk about the lift-off event of 2022 as an example of the latter type of shocks. And my interpretation of the data is going to be that the European monetary unions fare quite well with the first type, but not so much with the second. And before going there, let me actually give a brief detour about the data that I'm going to use. So in order to understand how the monetary stance of the ECB changes when you have this type of shocks to sustainability, you're going to need to have data on a monetary instrument like nominal rates and data on an outcome, inflation. Rather than using realized data, I'm going to use expectation data. And in particular, I'm going to use the expectation data on future nominal interest rate and future inflation that are implied by the term structure of nominal and inflation-protected bonds. Now, in the companion work with my co-authors, Dovis, Jorgensen, and Kirpalani, we actually use this data to test for the stability of the US monetary reaction function post-2020. And the basic idea is simple, like suppose that you have a Taylor rule, like a monetary policy reaction function, which basically tells you, relates the nominal interest rate to inflation and potentially the output gap. You can always restate that relationship in expectation space and then use this sort of high-frequency, real-time data on what the market thinks about future nominal interest rate and future inflation to learn what they are thinking about the response of the monetary authority to inflation changes. And in the present context, these are going to be sort of nice because I'm going to look at event studies, so it's very nice to have very high-frequency read of the market. So here is a plot. Actually, I'm going to first start with the US data. On the left axis, on the left panel, I have expected nominal interest rate and expected inflation. So each dot is like a day. And basically what you can see from this scatter plot, and I actually have that for two different subsamples, sorry. One is 2017-2019, and the other is 2020-2022. So when you look at this data, first of all, you see that there is a very strong relationship in the market between expected nominal rate and expected inflation, consistent with what a Taylor rule would prescribe. And the other thing that you notice is that the slope of that relationship can vary over time. So, for example, in 2017, 2019 is way steeper than during the COVID recession. Now, if you do this more systematically, you do see that there is over the past 20 years, this slope implied by the market was very stable. It basically didn't move, and then it dropped in the post-COVID period. Now, in the paper, we basically argue that this is evidence consistent with the shift toward the more dovish monetary policy, which was the average inflation targeting that was introduced in 2020 by the Federal Reserve. Now, suppose I do the same for Europe, I still get a similar striking positive relationship between the two, and also a sort of a shift toward the more dovish monetary reaction function. So you see that the coefficient that you estimate in 2020, 2022 is way below what it was before. And we didn't have a shift in the monetary regime, so perhaps this could be related to sustainability concerns. Like public debt in Europe increased a lot, and that may push basically the ECB to be a bit more dovish about movement in the interest rate. So to explore this, I'm going to start with my first event study, which is going to be this idea of basically studying a particular shock to these sustainability constraints. And I'm going to think about the formation of the Italian government in 2018. Now, for those that are not familiar with these events, essentially you had election in Italy, you had 3 different coalitions, and the result were basically one-third, one-third, one-third. So none can basically govern by its own. So you had between March and May, basically a period in which it was not clear what was going to happen. But then all of a sudden, one party, the Five Star Movement, started to came into agreement with a faction of the other coalition, the League, on a platform that was anti-EU, anti-austerity. Okay? Now, here I'm plotting the Italian spread vis-a-vis Germany. What you see is like once that starts, you see a lot of volatility in these spreads. And we can essentially pinpoint to each single day of why they are increasing. Well, sometimes they increase because they leak to the press the name of the next finance minister, which is, by the way, someone that wrote a plan, the very detailed plan on how you exit from the euro. So essentially, during those days, you have sort of the market reacting to, okay, who's going to govern Italy, what's going to be their policy, and they're going to think about that as a shock to the sustainability constraint. Like now, all of a sudden, it becomes more tight for the ECB. So the question is going to be, how do the market interpret this shock and how do they, what are the impact on expected inflation and nominal rates? And these shocks are actually quite predictive for expected inflation and expected nominal rates for the euro area. Like if you regress innovations on the Italian spread during those months on innovation on these variables, you basically get R square of 0.3 or 0.4, which at the daily frequency, they are quite high. But the way that the finding is essentially that the higher is sovereign risk in Italy for this exogenous reason, the lower is expected inflation and the lower are expected nominal interest rate. And in particular, nominal interest rates are way more reactive than inflation. So the implicit Taylor rule coefficient that you can read out of this experiment would be actually twice as large as the unconditional one. So as my reading of this is that basically bond market views a debt crisis in the Eurozone as a deflationary event for the Union. And this is actually in sharp contrast with what happened in emerging markets. They also expect the ECB to accommodate these shocks aggressively. And there is, as a result, not a big change in inflation expectations. So if you look at expected inflation over these 2 months, they just go down by 15 basis points. So they basically don't move. So the direct shocks do not appear to interfere with the price stability mandate, at least when they are idiosyncratic, like in this case. So basically they are demand shocks and the central bank is reacting strongly. Now let's look at the other type of shocks, and here, basically what I'm going to look at is the lift-off event of 2022. So on this graph, I'm plotting in red the expected nominal interest rate over the next 5 years. You know, starting from March and the invasion in Russia, you had all this inflation report. So the market started to price in a tightening of monetary policy in Europe. So that's why you see the red line going up during this period. On June 5, the ECB actually decides to end net purchases under one of these bond purchasing program and to raise interest rates. And immediately you see sovereign spread reacting. In particular, you see sovereign spread increasing in Italy and Greece, but also in other countries like Portugal and Spain. 1 week after, they had an emergency meeting, an ad hoc meeting, in which they reversed partly the previous decision on the bond purchasing program and introduced this TPI. Now, what happens from June 15 onward is that basically the expectation of the market about nominal interest rate in Europe start to go down. So here of course, it's hard to understand, or at least to make the counterfactual, because there are other shocks going on. But what you can do is, like, let's actually compare the relative monetary policy stance of the ECB with respect to the Fed, and the relative inflation path for the euro area with respect to the Fed. And the idea is that, you know, the Fed is kind of working, in my mind, as a counterfactual in which you don't have this type of sustainability constraint. So what you see when you do that, the blue line is this relative monetary stance of Europe vis-a-vis the US. You see that throughout June, basically, the market is thinking that Europe needs to tighten relative to the US because the rates were still low. But then from June 15 onwards, they have this sort of reversal in the expectation. And inflation kind of goes in the other way. So inflation, they were expecting basically inflation to catch up, like, you know, to reduce relative to what was happening in the US. And once you had this, you know, reversal expectation in policy, you have also a reversal expectation in expected inflation. And so I think that this is a case in which the sustainability constraints actually are interacting in important ways with the price stability mandate. So let me conclude with this slide. So aside from price stability, the ECB wants to keep a sustainable monetary union. These two objectives may at times clash, leading to a trade-off. The ECB has designed the institution over time to ameliorate this trade-off. So you can think about OMT and TPI and all these bond purchasing programs as ways to keep at bay these sustainability constraints. And they appear to have worked when we look at sort of these direct idiosyncratic shocks to sustainability. But these considerations are still constraining the conduct of monetary policy, especially in tightening cycles. So the fact that you need to raise rate and you have public debt of 140, 150% of GDP in the European Union seems to be an issue. Now, to fully solve this issue, you need to focus on public debt sustainability. There is trying to do institutional reform about it. My view on that is that it's actually hard to sort of solve it just by adding one more law or one more institution. There are really challenges in Europe to keep at bay public debt. One is, if you actually look at the dynamics of public debt in the past 25 years, it's a step function. Every crisis it goes up and then it stays there and then it keeps on going. And really, why is that the case? Well, you know, Europe has already a very high level of taxes. The budgets are becoming very inflexible because, you know, you cannot really cut pensions without having people going on the street. So there is a lot of tax intolerance. So the governments have a really hard time to consolidate. And I'm gonna leave it here for questions.
This was great. So we have about 15 minutes or so for Q&A. And when I'm going to take my prerogative and ask a question, and then we'll go around the room. And when you raise your hand, please identify yourself. You know, in 1999, Europe created a monetary union, but it did not create a fiscal union, and that's been a source of difficulties, at least ever since the global financial crisis. So the question I have for people on the panel is, what's the likely path forward to creating a monetary fiscal union like the US had, like Alexander Hamilton envisaged? Okay, so that's my question. And anybody want to, yeah, okay.
Yes, I mean, the moment was very promising. We had COVID, we issued common debt. I thought, I was in Parliament then, and I thought this was the Hamiltonian moment for Europe when there was a big bond issuance, the first real Euro bond, common bond, big, large bond issuance in Europe, 750 billion. The problem is that it was kind of a half step because we put the debt issuance and we spend it, but we didn't decide how to fund it. That's easy, right? So the revenue side was forgotten, and basically I think the politicians' view at the time was like, okay, we put this big thing here and then we'll have to find the money, so then you just get this thing going. Remember the bicycle metaphor of Monet, which is like, you know, Europe is this thing that kind of, it's always falling forward and building in each crisis. But of course, this is a more difficult thing because now we are facing this, all these problems you already mentioned in terms of defense and all that. And we're going to have to find these sources of funding, common sources of European funding. My view in that sense is that we wasted a very good opportunity to take that really first Hamiltonian step you're talking about. And the fact that, you know, the recovery plans that were funded with all this money haven't been entirely, well, they haven't been very successful. The Italian numbers come from something called the super bonus, where basically Italy is paying 110% of your house renovations. So you have an incentive with your home builder to get as big a renovation as expensive as possible, because both of you can split that extra money. So the fact that this didn't work very well and that we didn't put the revenue in place probably means that it's further than it was before the crisis. And I am not very optimistic about the political will. I think that the comment that I mean, it's true that the resistance in Europe to anything as a society's age is becoming stronger.
Okay. Does anyone want to jump in on that, or I can move to the next question?
Thank you. Sebastian Edwards from UCLA. A very interesting panel. I have a question about, I think that one way or another, all the speakers, although the first two papers mostly, the CBDC and currency substitution. So Mike Bordo in the 80s wrote some great work on currency substitution. And I think that Markus had one bullet point about the emerging markets. And we're going to hear about Argentina later today. Once CBDCs are around and you can have euros that are backed by the ECB or dollars or loonies or whatever, why would Argentinians hold any pesos? And one of the things that at least that we either learned or that Milton Friedman tried to convince us is that in order to undertake monetary policy in an effective way, the demand for money has to be predictable. It's the famous book with David Meiselman. So the question is, what are the beyond Europe and the US or beyond the advanced countries implications of CBDCs for Asia, Africa, and mostly Latin America? And I think that that's still something that hasn't been addressed. Thank you.
Markus.
Yeah, that's a big issue for the emerging economies, and that's why they were very afraid of CBDCs, and they developed their own CBDCs in order to be ready to this, because people might not use their own currency anymore, and then you don't have any power to conduct monetary policy. You lose your monetary sovereignty. I mean, of course, what you can do, you can just outlaw, saying, okay, nobody in Argentina can hold a digital euro by law. Yes, I mean, there must be some smart artificial intelligence control or something to outlaw it, but that's probably the only way to prevent it. So that's why initially when the whole wave came, the emerging markets were the first ones to set up CBDCs, just as a defensive measure to protect their unit of account in order to be able to conduct monetary policy. But that's a valid concern.
Right. But I have Volker Wieland.
Maybe two brief questions to Luis and Klaus. First, it seemed to me the ESM worked reasonably well. It did require the backup of the member countries for funding. You propose a stronger European financial institution, fiscal institution, which also you propose to change the voting. But then where would that institution get its funds? I mean, if you don't, so for example, in Germany, there was a constitutional court case where they said, well, if you want to have an unlimited budget or call on the German budget to increase the capital of the ESM, you need a parliamentary vote. It worked, right? But so if you want to reduce the votes needed, don't you need some extra funding directly, say some tax powers? That's one question. And the other question, you mentioned the TPI. It seemed to me with the OMT, the ECB was much better protected because they could say the country needs an ESM program. But now the ECB came by itself and said, no, we want to have another program which does not rely on that. Klaus talked about this a little bit, but could you give us the reason why did the ECB want to have this additional flexibility when it loses this backing, or decided itself to lose the backing of the ESM program?
Volker, thanks a lot. Yeah, that's of course a key question. The ESM was one of these blue part which improved the situation in the sense that it took burden from the central bank and moved it to the fiscal authorities, which created the ESM as a crisis management institution. So that was a good development. The ESM got capital from the member states, but this was always said, at least you could read it in the press, it's not enough if a big country has to be kind of funded by the ESM when you don't want the sovereign debt restructuring, but you want to start with a program where you fund upfront. That was possibly too little in the ESM. The difference to what we suggest is certainly that member states will have to fund a fiscal institution, which could be intergovernmental like the ESM, but you are right. That means that the German Bundestag can no longer veto if there is a majority voting or a qualified majority voting. But without that, you will always have the central bank being in the fire, being burdened when these things happen. If the fiscal institution is not strong enough, cannot act quickly, there will always be an argument, and a reasonable one, that the central bank is much quicker, can much faster decide. So you have a trade-off. We are designing a good solution for the medium term. If, of course, there's political resistance and it will not be set up, we have to muddle through where we are. And then I hand over to Luis on TPI. One point, everybody understood that TPI was needed in the view of the central bank, and I think it was a reasonable argument that if we increase interest rates, is the talk we have heard just now, the sovereign risks may increase, so we have to protect the transmission mechanism. So it was a way to get interest rates up.
No, just very briefly. I mean, the difference between TPI and ESM is exactly, and previous mechanisms like OMTs, is exactly what you're saying. Let me try to avoid the Euro words. So basically when Draghi did this, when he did whatever it takes, he said there is fiscal backing, the member states are on the hook, and there are conditions, which means that the ECB, as you very well said, it's protected, because the ECB can say, well, you're not doing the right thing, I withdraw, and the member states are on the hook. When they did TPI now, there is no fiscal backing, there is no member states on the hook, and there are no conditions. So basically, if the member state who is receiving this kind of bailout program doesn't actually, who is receiving this support for their bonds, doesn't actually behave and continues doing crazy stuff, the ECB doesn't really have the possibility of getting out because it's going to create a financial crisis, or at least it has much more, it's much more on the hook. Why did they do that? I think it's politics. I think that when Draghi was there, it was the whole sovereign crisis. He had a lot of power, and he was able to persuade people. If you want me to stay in, you're gonna have to create this institution, this ESM, these conditions. I think when this happened again, when the inflationary period that was discussed in two of the papers started, there was no this political strength to. I mean, the member states just thought, okay, ECB can do it. Let the ECB do it, right?
Okay. Athanasios.
We hear all of these difficulties with the incomplete project in Europe, and it's very useful to hear proposals, but many of the proposals have been put down require cooperation by governments and other institutions and so forth. Since this is a conference on monetary policy, I thought I would ask a specific question about one of the issues that the ECB could fix on its own and improve the functioning of the euro area. That is a known vulnerability and has not been addressed very well in recent years. It's very simple. We need to look at the plumbing of how policy works. And the ECB is the only central bank on the planet that relies on credit rating agencies to determine the eligibility of government debt. This is a known source of fragility. It has created multiple episodes of crisis in the past. And we have this wonderful experiment with the pandemic that Luis mentioned, the issue of would the pandemic have turned into a Hamiltonian model. The ECB suspended the use of credit ratings for government debt during the pandemic, and this wonderfully stabilized government bond markets. And then, unfortunately, for reasons that have not been explained or mentioned in the policy review documents that the ECB has completed since then, 2 years ago, in the spring of 2022, the Governing Council announced that it would return to the pre-pandemic collateral framework with full knowledge that this would create instability. And of course, the instability came. I was interested in the case study of the TPI and then discussion we have on the TPI. But of course, the TPI was introduced in order to partially solve a problem that the ECB had created just a few months earlier by reintroducing reliance on credit rating agencies for government debt. So I ask this to those of you who have proposed solutions for the ECB. Isn't this a fairly easy thing that the ECB could fix on its own? What is the justification for current practice? And Luis, I understand politics is part of the answer, but when we're talking about an independent central bank, I don't think that's a satisfactory answer.
Okay, so you got out my get out of jail card. So I think that the rating agencies are a very bad solution. We saw it during the financial crisis. The problem is that I don't think a better solution has been found in Europe that avoids political interference. I mean, using volatility or using other measures would probably be preferred. But I think it's a question of what can we talk to each other as different countries and agree that that's not manipulable by all of us and that it's just external to us. And that kind of external instrument hasn't been found apart from the credit rating agencies, which I agree with you, have been kind of following, creating procyclicality and all these things that you're mentioning. I agree with you. It's not a satisfactory solution. But I think the absence of any collateral framework would be worse, or the absence of any guide to the collateral framework would be worse. So yeah, I guess politics.
So we're just about out of time, but Steve Davis has had his hand up, so why don't you close off the session?
Thank you. My question is directed mostly to Luigi. As I understand it, the ECB took on itself the sustainability constraint. And it did so at least as far back as the Greek sovereign debt crisis in 2010, 2012. You could have imagined a different response to that, which was to facilitate a temporary or permanent exit of Greece from the Eurozone. Of course, that would have involved some sovereign default and probably a major banking crisis inside Greece and maybe beyond. But all of the difficulties, the lack of fiscal discipline that you mentioned in your remarks that have come up elsewhere, it seems to me flowed from the early decisions to essentially impose on itself these sustainability constraints. They've grown more encumbering over time. They've evolved into new ways for political leaders to avoid fiscal discipline and so on. So I'd just like to get your response to that and see what you say.
Yeah, no, I think this is a very fair question. I think it was very in the mind of Draghi and Trichet at the time. In fact, you know, the whatever it takes was whatever it takes to preserve the euro. And I think in the mind of the chairman at the time, preserving the euro meant there is no exit. Because the moment that there is an exit, It's not anymore a monetary union, it's fixed exchange rates. And we know that those, once there is a possibility of exiting, we know that it creates all sorts of problems for the countries that are in. So the way, and this was a time in which actually people had in mind exit. So there was this thing of redenomination risk. So markets were pricing a possible exit, and I think what they, in one way it's right, like they put the constraint themselves because they want to preserve the euro. So that's, I think they felt that's part of the mandate, even though it's not in the mandate. But I think that's at least my view of why they did it. But you're right, like they could have basically said, well, let's just let someone.
Klaus, did you
Two
want-
sentences
2
very
seconds.
briefly. It's a very important question. Our proposal, John, Luis, myself, is to make it possible to default in the monetary union. And the fact, the missing parts of the treaty or the secondary legislation meant that there was no possibility for an upfront debt restructuring in Greece, and that created a lot of economic and social costs. So these missing parts of the treaty have costs. If you want to exclude exit, which I think exit should be excluded, it's not part of the European mindset, you have to have the ability, in an extreme case, to have an upfront sovereign debt restructuring and not impose extreme costs via fiscal consolidation.
Okay. Well, thank you very much. I know we have another session starting. It was great.